Right. Good evening, viewers. Thank you for joining us this evening for this lecture, which is a continuation from yesterday's lecture. Um, I'm requesting you to subscribe to this channel so that you can receive more information and you can watch more of the videos that I'm going to post here. So also you need to click the button, the reminder button, and make sure that you don't miss any uploads. So today, as we continue with our lecture, we are now going to focus on um, an example that follows yesterday's presentation. So basically yesterday, what we did was to discuss the structure of a financial statement presentation, that is the statement of profit or loss, and the statement of financial position for a sole trader. So today, what we want to do is to start first with a recap of yesterday's activities. So this is the structure that I presented yesterday, which shows that we have in the trading account, we have revenue, cost of sales, and gross profit. However, I need to mention that there are some circumstances when the company can have other income. So other income, which is not from trading, uh, should come after gross profit. Then soon after that, we then bring in our operating expenses. And as we explained yesterday, you bring in your operating expenses and then you sum them up, then you give the total there. Then these are how you come up with the various figures for the statement of profit or loss. So like, for instance, revenue, you bring in your sales and then you deduct your returns, which should give you the revenue. And then we also have the cost of sales, which you are going to bring in your opening inventory, your purchases, your carriage inwards, your returns, your goods. Then you get your goods available for sale, and then you deduct the inventory, as you can see here in this slide. And then that is a note of how you compute the net book values for your non-current assets. And then that is the structure of your statement for financial position. And the numbers here are indicating the note where we can locate the computation of the various values that you have for your non-current assets. And then you have the section for your current assets. Then you get the total assets. Then you have the equity and liabilities section. So basically, this is what I presented yesterday. And I said that for the purpose of this statement of financial position, we are using the equation as assets is equals to capital plus liabilities. And there are other ways you can present. You can use the formula assets minus liabilities, which is equal to capital. That's another way to present your statement of financial position. But for this purpose of this lecture, we are going to use assets equals to capital plus liabilities. So let us look at this example. This example is for Turkey's sole trader. We are given this information. This information does not state whether we have a credit or a debit balance, but you should be able to pick up whether it is a credit or debit balance by virtue of knowing the classification of each item. So let us start with our capital. We all know that by now you should be able to understand that this is a statement of financial position. So I will indicate by just ticking that this is statement of financial position item. Then for trading, I'll underline sales is for trading. Then this is statement of financial position again. Then that's trade accounts payable. These are liabilities, and our liabilities are for the statement of financial position. Then we have returns outwards. Returns outwards, as we indicated yesterday, these are goods that we will have purchased, but for some reason we decide to return them to our suppliers. Maybe the goods are damaged, or we didn't agree on the price, or there's some contract challenges, so we return those goods. So this is an item for the trading account, which should adjust our purchases. Then we have allowance for doubtful debts. This item here should have, if there are any changes to the allowance for doubtful debt, it should have an effect on our statement of profit or loss and other comprehensive income. So we should be able to pick this from the adjustments. Remember, today, the focus of this lecture is to attempt some simple adjustments. We also want to understand which items go to the statement of financial position, which items are supposed to be in the trading account, which items are supposed to be operating expenses, which items are supposed to be liabilities in the statement of financial position, or assets, or current assets. So we are doing the classification, but also we are also going to attempt to do some simple adjustments. So then we apply that structure that we learned yesterday to try and figure out if our structure that we came up with yesterday can give us a good result or view of the two statements, that the statement of profit or loss and the statement of financial position. So, as I said, that this allowance for doubtful debt, we should be able to see an element of adjustment in the additional information. Then we have discount allowed. As I said earlier yesterday, discount allowed, this is an expense. So this item is for the profit or loss and other comprehensive income. Then we have discount received. I want you to take note of this item here. So I'll put an X here. Discount received is an item that should go after the gross profit, and it should be treated as other income. Then let's go to purchases. Purchases, these are items for the trading account. So we should be able to use this in the trading account. Returns inwards. So what is happening is we have sold. So after selling, possibly our clients realize that there's something wrong with the goods that we sold to them. So we should be, they may decide to return the goods, and if they return the goods, we should be able to make the adjustment in the trading account. Then carriage outwards, this is an expense. Carriage outwards is an expense, and we should be able to make an adjustment in the profit or loss and other comprehensive income. But drawings here, these items or the money that is actually being withdrawn by the owner of the company. This is a sole trader. So sometimes the sole trader, the owner manager may decide to use some money for personal use, or may decide to use to take some inventory for consumption or for other purposes that are not related to the business. So we call those drawings. If it is items, then we have to value how much was taken by the owner, and then we include that in the statement of financial position. So the effect of drawings is that it should reduce the equity of the owner, because we have the capital that the owner has invested, and then we have profit that the owner has made. The business makes profit. If the business makes profit, then we are going to add the profit to the capital, and then because the owner decided to take out some goods or to withdraw some money from the business, we are going to deduct that from the owner's equity, which means that the capital plus retained income, then we deduct the drawings. So this drawings is an item for the statement of financial position. Then carriage inwards. Carriage inwards, this is an item for the trading account. What happens is that when we acquire inventory, when we purchase inventory from our suppliers, we need to bring them to, if our suppliers are not going to bring them for free, then we need to pay for freight to deliver this to our warehouse. So we are going to be charged. So now, then we have rent, rates, and insurance. This is an item for the statement of financial position, and this is an expense. But we should be able to, sometimes there's cases where we have prepayments of rent and rates or insurance. So we need to make up some adjustments for these items. Based on the matching concept, we are saying that we need to bring these to the correct period in which they have been spent. So if we have prepaid, say, 5,000 worth of rent, which is supposed to be consumed next month, it means that the actual expense is not for this month. What we have simply done is we have paid, but we have not spent. It's not an expense for this period, so we need to remove the aspect which is not an expense, and then we make it a prepayment, which is an asset. The same applies with heating. Heating is an expense, so we expect that heating and lighting, these are expenses. We expect that if there are no prepayments for heating and lighting, then this whole amount should be for this period as an expense. Then we have postage, stationery, and telephone. These are expenses again. Postage, stationery, and telephone, they are expenses. Advertising is an expense. So here, when you talk about postage, telephone, when you are doing your business, you are actually, you incur certain expenses. You incur costs of running the business. So whatever depletes the assets or the economic value of a business is an expense. Or sometimes it increases the liabilities, so that will be an expense. So that is in the event that we have accruals, it means that our liabilities have increased. So when we have liabilities increasing or assets decreasing, it means that we are spending. That's expense. Salaries and wages, again, this causes a decline in economic gain. So we have those as expenses. And also remember that expenses are spent within the current period, and they have got nothing to do with the foreseeable future, which is the difference between an expense and assets. Because assets, we are saying that for something to be called an asset, it is something that because of some past events, we have acquired or controlled uh, that resource. And since we have controlled that resource, then we expect some future economic gains, or uh, we expect gains into the foreseeable future, which means that if we acquire something because of past events, um, or we control it, and then we expect from it, we expect some economic gains into the foreseeable future, that is an asset. But expenses is something that we consume during the period uh, of um, of trading, which is if we are in 2020, in 2022, uh, it means that whatever we pay for in 2022 is going to be consumed in 2022, and it's got no impact in the future, which is 2023. That becomes an expense. Then bad debts, because sometimes we have people who don't pay, they decide not to pay. So if people don't pay, we have to write those debts off. And this is a bad debt, and we call that an expense. Then we have, so this is bad debts. So we have cash in hand. Sometimes we have cash um, in the in the cash box or in the safe, and we may also have cash in the bank. But this cash is an asset because we can use it in the future. We can use it now, but we can also use it in the future. Then we have inventory. This is opening inventory, because you see that yesterday I explained that usually when you see inventory that has the date 1 January, 1 January, which is the beginning of the year, and in the context of Zimbabwe, we expect that that inventory is the opening inventory. Sometimes it's not written that this is opening inventory, and you need to know how to identify opening inventory and how to identify closing inventory. One other aspect is you will have been told the that the trading period, or when the trading period ends. So in this aspect, we were told that this is 31 December 2021. Um, these are extracts from activities for the year ended 31 December 2021. So, which means that January 1 was the beginning of that trading period. And having 1 January here, 2021, it shows that this is the opening inventory. Then trade receivable. So this is again, sorry, this is not the inventory that we take for the statement of financial position. So this item here is an item for the trading account only, for the trading account only. Then we have trade creditors, trade accounts receivables. Sorry, this is an item for the statement of financial position. What happened with trade accounts receivable is that we will have sold to our clients on credit or on account. So the sum of all the account balances from our clients will give us the trade receivable figure. Then we have fixtures and fittings at cost. So the fixtures and fittings at cost, these are uh, assets, because when we come up with fixtures and fittings, we are actually preparing for trading. We are preparing if it is a shop, if there are offices, it means that we are preparing them for use into the foreseeable future. It's not going to be consumption only for that period, but we may use it in several other years to come. So then we have provision for depreciation. Provision for depreciation, this is the sum of all depreciation charges for the previous years. And in this case, because we are given 31 December here, you need to be very careful, because since we are told that this provision for depreciation, this figure here comprises depreciation for up to 31st December 2021, because in most cases, we are given provision for depreciation for the previous years, and then we are told that the depreciation for the current year is so much, or we are actually asked to compute the depreciation for charge for that period. But in this case, we have provisions for depreciation up to 31 December, which means that this figure here comprises depreciation charge for the year 2021. So when you are preparing your statement of financial position, it means that you are only going to use these two figures here, the 120,740 minus the accumulated depreciation, which is 63,020. So but look, we also have what we call depreciation expense. So this depreciation expense, so here you are not supposed to actually mark it, because I was underlining items for the statement of financial position, but this is what you need to underline here, the depreciation expense, which is this figure. So what it means is that this 12,000 is also included, this 12,000 is included in this figure here. So you need to be very careful whilst you are going to calculate the net book value for fixtures and fittings. So let's proceed to, I'm going to clear these drawings, and then we move to the next slide. Now, the following additional information is available. So this is what I was saying, that when we are given information, we need additional information. This is a very important information, because this is where we are going to actually come up with our adjustments. Let us review the information that we have. So what we have here, item number 1 is inventory at the close of business. So this inventory here is coming at the close of business, which means this is our closing inventory. This is our closing inventory, which is an item should be for both. So we can underline it because we are going to use it in the trading account. And also we are going to tick it because we are going to use it in the statement of financial position. So please take note that the amount that we require for the statement of financial position is the inventory at the end of the period. What we are simply saying is that after we have traded, we remained with certain amount of goods, and those goods, the value of those goods is an asset to us, because remember, when we say that inventory itself is an asset, because we are going to use it in future. So Now, let us look at item B there, which says insurances have been prepaid. So take note of this word prepaid by this amount. So automatically we know that this amount here is an asset. So we need to highlight that it is an asset, but the same amount is going to have an effect on the in the statement of profit or loss and other comprehensive income, because if you remember, we have insurances in the uh, extracted information that we have seen just prior to this slide. So there is also heating and lighting is accrued. So take note of this term here, accrued, which means that we have an expense, and we also have a liability. So I'm going to underline and tick. This has got an effect on both the statement of financial position and the statement of profit or loss and other comprehensive income. Why am I saying so? When heating and lighting is accrued, what it means is we have already spent, but we have not paid. That's what it means. We have spent, but we have not paid. So which means there is a liability on our part. And but actually the expense already exists. So in order to match our expenses to the period, we have to charge the P&L with the accrued expense. So at the same time, because it's a liability, we need to include it in the statement of financial position as current liability. Now, we also have rates that have been, so here it's insurances, prepaid, here is heating and lighting, here it's rates, and this one is rates is prepaid. So again, this amount here needs to be matched to its period. So if it has been prepaid, it means that this amount here is an asset. It is not an expense for the period. So if we have rates, so here we have got two prepayments, this figure and this figure. So these two are prepayments. So what it means is where there's insurances, we must deduct this figure from insurances because this amount here has not yet been spent. So in order to match to its period, we have to push it forward so it becomes an asset. The same applies with this figure. But for this figure, we have to bring it back to the current period because it is a liability we have already spent, and we want to match it to the trading period where it was spent. So then we have item number E. The allowance for doubtful debt is to be adjusted so that it is 3%. So this has got to be adjusted so that it is 3% of trade receivables, trade account receivables. So what it means is we are going to calculate 3% of trade receivables. The amount that we get, we compare with what we have in the extract that we are already given. So if this amount is high, it means that we are going to include the difference between the 3% and what is already given in the extract as an increase in the allowance for doubtful debt, which is an expense. The increase component will be an additional expense. So it should be indicated in the statement of profit or loss and other comprehensive income. But also remember that the 3% is going to affect the accounts receivable, which means that we are going to deduct that 3% from the trade accounts receivable so that we get the amount that goes into the statement of financial position. So the question here says required. You are required to prepare Turkey statement of profit or loss for the year ending 31 December and the statement of financial position as at that date. So let us now go through a prepared solution. So this is the suggested solution. What we are saying is from the information that we are provided, this information, we have this amount of sales, and then we have returns inwards, which is so we have this figure for sales, and then we are looking for returns inwards, which is 520,5624. So these figures are what we are the figures that we are working with here. So what you're going to do, you take this amount for sales, and then you deduct the returns inwards, and then this is the amount of revenue. Then to compute the cost of sales now, you are going to check the opening inventory. And in this case, the opening inventory is given in this extract here, and the amount is 15,654. So this is the amount we have here, 15,654. Then we look for the purchases figure. The purchases figure, which is where is our purchases? Our purchases are 135,680. And then we also look at the carriage inwards. This is the figure. So if you go back to check in the extract that we are given there for the trading period, you'll find this amount here for carriage inwards. So carriage inwards is the cost of bringing what we purchased into our warehouse, and then returns outwards. So after purchasing and bringing the goods into our warehouse, we then realized that there were some goods that were not okay, so we returned them out. Then after that, we have closing inventory, which is this amount there. So you should be able to pick the closing inventory figure from the additional notes, which is this figure here, 17,750. And then after that, you get the cost of sales. So next is you then compute the non-current assets figure. And for this case, this is quite a bit different from our structure that we presented yesterday, because you can see that there is no current depreciation charge. The reason is that we are given the cost, and then we are given accumulated depreciation for the entire, for the past and also the current period. So our current depreciation charge is given here. It's included in this amount. And we are already given what the amount is. So we don't need to include it here. All we need to look for is the net book value. So since we are given accumulated depreciation for the previous periods plus the current period, we just subtract that accumulated depreciation from the cost, and we get the net book value. So this is the figure that we want for the purpose of the statement of financial position. Then let's go for note number 4, which is heating and lighting. So you will notice that we have this in the extract, we have heating and lighting, which is this amount. Then we have accrued heating and lighting. So what this means is that accrued heating and lighting had not been included here because it is shown in the notes. So we are being told that after this, after all the costs that we have already charged, there are other costs that were accrued but not yet included. So we are going to add to the heating and lighting, and then we get 12,370. This is the total amount for the heating and lighting expense. So this color here, which I'm using from yesterday, I'm using this to represent items that go into the statement of financial position, and the green I'm using it for items that go into the statement of profit or loss. Then we have rent, rates, and insurance. Rent, and this is what we are given in the extract, the 25,973, but we have, out of this amount, we have prepayments for insurance, we have got rates prepayments. So these amounts here are included here, but we have actually not spent. So we are going to have them as assets. So we will deduct them from here. And because I've put this color here, I'm saying that these are assets, these two figures. So we deduct these two from 25,000, and then we have, this is our actual expense. So the two notes here are telling us about the matching concept. We are matching expenses to the period in which they are supposed to, they have been incurred. So you need to actually understand that. So now, allowance for doubtful debts. As I said earlier on, you have allowance for doubtful debt, which is 3%. So we are going to compute 3% of accounts receivable. So our trade account is this figure, which is 24,500. If you multiply that by 3%, you get 735. So 735 is the new allowance for doubtful debt, but previously we had an allowance for doubtful debt of 512. So the increase shows that the probability of debt is increasing, which means that when that increases, we have to increase the charge. So this becomes an expense. So probably by prudence, we are saying that we do not want to overstate our assets. So that's the prudence concept, because if we understate the provision, it means that we are assuming that we are going to collect more of our debt. But in this case, by increasing the provision, we are assuming that we are not going to be able to collect as much as we thought. So that becomes, this becomes an expense. Then trade accounts receivable. So we had this trade accounts receivable, and then now we have the allowance for doubtful debt for 735. We are going to deduct this and remain with the net trade receivables, which is the figure that we now expect to collect after providing for those bad debts. So now this can be the solution now. If you have gone, if you've been watching or listening or taking notes, you should be able now to pick that where the figure revenue is coming from, not 1, and cost of sales, not 2, then gross profit there, and then we have discount received, which we bring here to have the total revenue, which is this amount. Then we have our operating expenses, which is this figure here, and all these figures is what we have gotten from the notes. As you can see, it's either we take it from the extract, this figure, we calculated it. So which means I was supposed to indicate the note here. So which is, not 6, not 6. So this should indicate the note, which is this one, N6. So this is N6. So you should be able to indicate, you should indicate that this is not number 6, so that when an examiner is following the figure, they are able to check where you've gotten the figure from. Then we also have discount allowed. This discount allowed figure is from the extract, the carriage outwards. This is the cost. Carriage outwards is an expense to us. It's the cost of shipping out to our clients. So we pay for that. We charge ourselves that expense. Then rent, we've computed this. So we are just bringing it here after taking care of the prepayments. So the figure has come down. Then heating and lighting has increased because we have accruals. Then these other figures remain as they are in the extract, except for this one, which is in the notes. So this in the additional information which is given there. Then we now say this gross profit minus plus the discount received, we get this amount. So the total revenue less the operating expenses should give us this figure here. So the last leg is the statement of financial position. So I want you to clearly look at this statement of financial position, which I said earlier on. You are going to say, we are using the equation assets equals to capital plus liabilities. So this section here is for assets up to here. So our assets, we have non-current assets and we have current assets. So our non-current assets in this case, we have one item and we've computed the net book value. So this is the net book value. So we have computed it under note 3. So after that, we have current assets. So our current assets, this one is given, this one is given, this one is given. But remember this one, I said that this is the closing inventory. So this is inventory at the end of the trading period. So that is the amount that comes here. So, but this figure here is now adjusted for the allowance for doubtful debts. So you need to take note of that the accounts receivables have been adjusted for allowance for doubtful debt. Then we have insurance premiums, prepayments. So insurance prepayments, these are the prepayments that we talked about earlier on, and then the rent prepayments. So we are saying because we are matching expenses to their period, to the period in which they were incurred, we needed to remove these from the amounts that are given in the extract and make them our assets and move them to the asset section, which is current assets. So after that, we have our total here, which is total asset value. So the total assets there is 1,10764. Now, we then come to equity and liabilities. So you will see that this one is capital plus liabilities. Now, capital plus liabilities is this side here. So this side should be equal to the side above. So our equity here is made up of capital, then the retained profit, then we deduct. We are supposed to put parentheses there. We are supposed to put parentheses on this figure. So effectively, if we add this to this and deduct this figure, we should get this figure, which is our equity. Then our equity should be added to the value of liabilities. So in this case, our question does not have non-current liabilities. So it only has current liabilities. So in the event that there are non-current liabilities, it means you need to have another section for non-current liabilities. And then you add current liabilities plus non-current liabilities, which you will then add to equity. But for the purpose of this question, there is only current liabilities. And this is what we have. The trade accounts payables and accrued expenses, heating and lighting. This is arising from the additional information where we are told that some expenses for heating and lighting have been accrued. So once they are accrued, it means that we have already incurred. So in order to match them to the trading period, we are supposed to make them an expense, and then we bring them as a current liability. So the total of this figure here plus this figure here, these two figures, if we add them, they give us this figure here. And these two, as you can see, are equal, which is what this equation is saying. So for today, that's it. We conclude by this question. And once again, I ask you to subscribe. And also, if you have any questions, you put them in the comment section. If you want to discuss more, make your request in the comment section, then we can discuss. Or if you have any question that you would want us to tackle, just send it, and then we tackle it, and then we upload that question. Thank you very much, and enjoy the rest of your evening.